Imagine watching your money grow year after year while you continue to invest, and when the time finally comes for you to enjoy it, everything you earn is 100% tax-free. This is what makes the Roth IRA such an amazing tool. And in this video, we're going to talk about the 6 best ETFs for a Roth IRA and what a Roth IRA is all about. So let's cut to the chase. Key features of a Roth IRA. A Roth IRA is a type of individual retirement account or IRA that you fund with after-tax dollars, some money that you've already paid taxes on. The benefits of a Roth IRA is that all that money that you invest in the account grows tax-free. Now, this doesn't just include the gains from your investments, but also your earnings from those investments in that account, like its dividend income or any other distributions. Those will be tax-free as well, making it possible to live off the growth of your investments and the dividend income it provides. A Roth IRA can also be passed down to children when you're no longer around, and the withdrawals will also be tax-free for the inherited IRA. And in the case you need access to those funds, you're able to take out up to 100% of what you contributed to your Roth IRA at any given time with no taxes or penalties. Now, there are some requirements to keep in mind. The first being that there's limitations to how much you can contribute to a Roth IRA. For example, for 2025, the max contributions are $7,000 if you're under 50 years old and $8,000 if you're 50 and up, and you have up to the tax deadline on April 15 to put in your contributions for the previous year. Second is the withdrawal rules. Roth IRA withdrawals are tax and penalty free after the age of 59 and a half, given that you've held the account for at least 5 years or more. So there will be a 10% tax if you withdraw your money early from your Roth. Keep in mind this is for earnings and not what you contributed to the account. Now that you have a better understanding of what a Roth IRA is, let's get into the best ETFs for it. Since we want this account to grow as much as possible thanks to those tax-free benefits, one type of ETF that's going to give us the most opportunity for potential growth is none other than growth ETFs. These type of ETFs hold companies that are quickly scaling their businesses and are predicted to have higher than average growth in market share and revenues. Growth ETFs are going to be for those that are looking to maximize the potential returns of their portfolio, as there are many of these ETFs that have well outperformed the market and brought in some huge returns over time. But keep in mind, while these ETFs can be extremely rewarding, they do come with more risk and they're much more volatile. Because of this, they might make more sense for someone with a higher risk tolerance or someone with a longer time to invest. Here's a list of a few different solid growth ETFs that you could come back and take a look at later on. One of my favorite growth ETFs is SCHG, the Charles Schwab US Large Cap Growth ETF. This ETF contains around 231 stocks in total, with its top holdings in companies like Nvidia, Microsoft, Apple, Amazon, and Google. And the sectors that make up this fund include technology up top, communication, consumer discretionary, and a few others. As you can see, this fund is pretty tech heavy, which is going to be the case for most of these growth funds in general. When it comes to the fees, SCHG has an expense ratio of 0.04%, costing you just $4 for every $10,000 invested. Now, the best part about growth are those returns, which make it hard to beat. And SCHG has provided annual returns of over 16% over the last 10 years and over 18% in the past 5 years, which is pretty insane. And if we compare this to the overall market, like with an S&P 500 fund, over the last 10 years, growth has really outperformed in its returns. While the trade-off is for some more volatility, you can see how growth ETFs can offer the potential for some serious returns to help grow your money much faster. So depending on your level of risk tolerance, having some exposure to growth could be a nice plus. This next type of ETF is going to be a broad market ETF. So broad market ETFs hold a diversified basket of stocks, giving you exposure to a variety of companies, industries, sectors, and for some funds, countries as well. They're broad market because they cover a large portion of the stock market. They do this by tracking large indexes, for example, like the S&P 500 index, which contains the largest 500 companies in the US. You also have the total US market indexes, so all the stocks in the US, and even total world market indexes, which would include US and international stocks. Since broad market ETFs hold different stocks which are spread over a variety of industries and sectors, this helps to lower the risk compared to being exposed to only one part of the market or a handful of individual stocks. Here's a list of some different types of great broad market ETFs, which you could come back and take a look at later on. One of my favorite broad market ETFs is VTI, the Vanguard Total Stock Market ETF. This ETF contains around 3,555 stocks in total, and its top holdings are in companies like Microsoft, Nvidia, Apple, Google, and Berkshire Hathaway. The sectors it's primarily exposed to include technology, consumer discretionary, industrials, and financials. Which you can see there's a better percentage spread here in its sectors compared to a growth fund. When it comes to the fees, VTI has a super low expense ratio of 0.03%, costing you just $3 for every $10,000 invested. VTI also pays a dividend, and it has a dividend yield of 1.2%, which it pays that out in dividend income quarterly. When it comes to performance, broad market funds like VTI have a strong historical track record of consistent returns over many years through all the ups and downs of the market. Over the last 10 years, VTI has provided annual returns of nearly 13% and just under 16% returns annually over the past 5 years, which is really great. You can see why broad market ETFs can be so valuable to a portfolio due to how well diversified they are, along with the consistent and reliable returns that they provided for so long. The third one on the list is going to be dividend ETFs. Dividend ETFs can be a powerful tool in a Roth IRA due to the income they provide. Dividend ETFs hold companies that pay out dividends, and dividends are part of a company's profits that are paid out to investors. Now, what that means for you in a Roth IRA is that all that income that you receive in that account is tax-free. So not only do you have the gains from your investments appreciating tax-free, but also the income you receive, making it possible for you to live just off your dividend income in your retirement without even having to pay taxes. Another nice thing to note is that dividend ETFs can provide you with consistent income, whether the market is doing good or bad, and they're also more stable and less volatile than broad market ETFs, while still offering the potential for appreciation. Here's a list of some different dividend ETFs that you could come back and take a look at later on. One out of the handful of dividend ETFs that I like for Roth IRA is FDVV, the Fidelity High Dividend ETF. This ETF contains around 123 holdings in total, with its top holdings in names like Nvidia, Microsoft, JP Morgan, Visa, and Coca-Cola. The sectors that make up this ETF are technology, financials, consumer staples, utilities, real estate, and a few others. For the fees, FDVV has an expense ratio of 0.16%, costing you $16 for every $10,000 invested. Getting to the dividends, FDVV has a pretty nice dividend yield of around 3%, which it pays out that income quarterly. As for the returns, FDVV has had annual returns of around 12.5% since it was created in 2016, and annual returns of almost 18% over the last 5 years. That's really great for a dividend fund. Now, one thing to keep in mind when it comes to dividend ETFs is that they can vary in their strategy and purpose. For example, some dividend ETFs may focus on higher dividend yields, which would mean it holds companies that pay out larger dividends, or it can focus on dividend growth, which would be companies that have a history of increasing their dividend payments every year. And some dividend ETFs may be more diversified and conservative in their holdings, like a fund like VYM, while others may be a bit more growth-oriented, like FDVV in this example. Nothing is wrong with either option, as it will depend on the type of investor you are. Dividend ETFs offer some great benefits to a Roth IRA, giving you the opportunity to not just capitalize on some great capital appreciation, but to combine that with some solid dividend income. Now, this next one is going to be up to you to decide, and that's ETFs to further diversify or enhance your portfolio. Now, depending on what type of investor you are, maybe you want to diversify your holdings even more into safer funds or assets, or maybe you're someone who's willing to take on a bit more risk for more growth potential. Well, let's talk about 3 different ones. For someone that might be looking for a bit more opportunity and growth in an area that they may not have much exposure to from other funds, you could look into a small cap ETF. Small caps are companies with market capitalizations or market values that fall between $250 million and $2 billion. With these being smaller companies, they have much more opportunity for growth, which could equal large returns for investors, but that also comes with a higher risk of declining as well. Many broad market funds offer little to no exposure to small caps, so you could use this to further diversify a portfolio. Here's a list of some small cap ETFs that you can come back and take a look at later on. One small cap ETF I like is AVUV, the Advantis Small Cap Value ETF. Just to give a brief summary, this fund holds over 700 small cap stocks spread over a wide variety of different sectors, and this fund has brought in some nice returns of over 19% in the past 5 years and around 12% in the last 3 years. Although these funds come with more risk, they offer some great potential for returns and the added diversification. Another one for someone that might be much more conservative and towards the end of their investing journey is bond ETFs. Bonds can offer a steady income and help to balance the risk of owning stocks, since bonds are less volatile and sensitive to market fluctuations than stocks are. They're for stability and not for growth potential, making them more attractive for those that are nearing retirement and looking to shift from growth to conserving their wealth. Here's a list of a few different bond ETFs that you can come back to and take a look at later on. You have a variety to choose from, but one that I do like is BND, the Vanguard Total Bond Market Index Fund ETF. This ETF contains over 11,000 holdings and gives you exposure to US government and corporate bonds with a mix of short, intermediate, and long maturities. And the yield is pretty nice. This fund does exactly what it's supposed to. This next one is for someone that wants to be much more aggressive with their portfolio and take on more risk, and that would be sector-focused ETFs. These types of ETFs are going to hold stocks that are concentrated in a specific industry or sector. This exposure would allow you to fully benefit from the growth or growth potential of that specific sector. But this also invites much more risk due to the lack of diversification, and if the sector takes a hit or is struggling, you're going to take the full brunt of it. Also, keep in mind that the markets move in cycles and different sectors will perform better or worse than others at any given time. One sector fund that I like is VGT, the Vanguard Information Technology ETF. VGT is focused specifically on the tech sector. This ETF holds around 319 stocks in total, and its top holdings have names like NVIDIA, Microsoft, Apple, and Broadcom, which make up a big percentage of its holdings. And over the last 10 years, VGT has provided over 570% in returns, which is amazing to say the least. And this, of course, is due to the tech sector being on an incredible run over these past years. Now, be sure to check out this video here if you want to learn about some different combinations of ETFs to build a solid 3 ETF portfolio to help you build your wealth faster, or this video here to see how $60,000 in the S&P 500 ETF VU could change your life. If you made it this far, thank you for watching, and don't forget to tap that like button and subscribe for more content, and I'll be catching you on the next one.